Hey guys, welcome back to Stacking Stocks as we figure out if and how Tesla will be affected by the Fed hiking rates in 2022. What could be looming for the EV giant? Cathie Wood affirms the ARK ETF's outlook as inflation and tech sell-offs appear to be the fund's biggest obstacles in early 2022. Recent fears over the Fed's pace of rate hikes roiled big tech, and Cathie Wood's ARK ETFs once again took a big blow. But as tech tries to recover, she's dismissing inflationary concerns. Cathie Wood and ARK Invest have been making headlines a lot recently, and that makes a lot of sense considering the downward trend that we've seen for her flagship ARK Innovation strategy. ARK Innovation ETF invests in U.S. listed companies focused on disruptive innovation, notably in areas related to DNA technologies, automation, robotics and energy storage, artificial intelligence, and fintech. Wood's concentrated wagers on often small, potentially disruptive companies are hailed as bold bets by her fans, but deemed pretty reckless by critics. They turbocharged ARK Innovation ETF's performance on its way up, but have now left it particularly exposed as the tide turns. We notice that the ETF's losses come as the technology-heavy NASDAQ Composite Index suffered its worst day since February last year. This followed a warning from the U.S. Federal Reserve that a faster pace of interest rate rises could be necessary to tame inflation and reflects expectations that the Omicron coronavirus variant will be less disruptive to a large global economy than previous strains of the virus. This led investors to dump shares in many of the technology companies that surged during the pandemic and buy into businesses in more economically sensitive sectors such as banks and big industrial groups that are expected to benefit from an economic recovery. The sell-off in ARK Innovation ETF continued a trend that had unfolded during the past few months and reflected an environment that was changing from a period of tepid inflation and historically low interest rates to rapid price growth and rising bond yields. Some analysts believe that many of the companies in ARK's portfolio have lofty valuations, lack of profit, and lack of cash flow, which doesn't give you much downside protection if they don't deliver. Now, Wood leverages social media often to communicate with investors about some of the volatility in her fund. She recently addressed concerns around inflation, the concerns that have been causing this tech grab that we've seen, and that it's really battered ARK as investors look ahead to possible interest rate hikes. Cathie Wood says that ARK Invest is actually focused on other measures about its assessment of inflation. And notably, she pointed to velocity, which is the ratio of GDP to money supply, and it's fallen since the worst of the COVID pandemic. Wood thinks that there are going to be some Fed governors and Fed presidents who are looking at statistics and are citing some that are still on their way up. There are others who are going to be citing statistics that are on their way down. But they want to err on the side of hawkishness or being too tight right now, certainly from a jawboning point of view, because they don't want inflation to continue to escalate. And of course, other financial institutions don't seem to be sharing that sentiment and are acknowledging that inflation might linger around for a while and even adjusting their forecast to price in possible rate hikes this year. Wood sees companies that profit from stay-at-home trends as part of an innovation category that includes Tesla and biotech shares. Among the arguments for innovation stocks are signs from the bond market that inflation expectations are moderating and a broad decline in commodity prices. At the same time, Wood said that she expects the U.S. economy will grow less than many economists expect in the year ahead, prompting a shift back into the sort of innovative companies that can grow regardless of the economic backdrop. Well, rate hikes are coming, but that doesn't mean growth stocks like Tesla are destined to fall. The final stretch of 2021 brought considerable speculation about several market trends, but one that's still being discussed is inflation. With prices rising, both investors and regulators are left to consider the best path forward for the U.S. economy. As other companies brace for impact, though, Tesla could stand to gain. As is often the case, these worrying market trends have led the Federal Reserve to impose strict measures. Specifically, Fed Chair Jerome Powell has confirmed that we can expect 4 rate hikes throughout 2022. Now, investors are raising questions as to what these developments will mean. But as it turns out, firms like Tesla stock may actually benefit. Ever since 2022 began, this electric vehicle innovator's market performance has been turbulent. Tesla kicked off the year by reporting impressive delivery statistics for the final quarter of 2021. Since then, however, controversy regarding international partnerships and general market forces has worked against the company. Tesla began by rising, but it has also seen several dips. Well, we understand that when rate hikes are mentioned, investors seem to lose confidence in certain stocks. As a matter of fact, when not one but four are on the horizon, it can certainly seem daunting as Wall Street ponders the economic landscape. But then rate hikes are not always bad for growth stocks. In fact, they can benefit them significantly. Let's take a look at what this could mean for Tesla stock. Investors have plenty of reason to approach growth stocks with caution going into 2022. We saw many such companies suffer losses in 2021 due to anticipatory fears about hikes being on the way. As a result, stock valuations were often pushed down. This type of trend can compel investors to sell off growth stocks. However, when it comes to rate hikes, investors may not have so much to fear now. We believe that the investors have evolved since last year and are now more capable of handling these types of situations. Once those rate hikes materialize, investors check their math and realize that gradual 25 basis point increases in the Fed funds target rate don't actually impact valuations all that much. Meanwhile, the fact that the Fed is hiking rates means the economy is doing well, which should mean that growth companies are growing their sales and earning more quickly. When companies can demonstrate increases in both sales and earnings growth, they can easily offset the valuation compresses caused by rate hikes. That can then cause such companies to end up rising even higher. Let's talk about Cathie Wood's flagship ARK Innovation ETF. Comprised of many high-growth stocks, this exchange-traded fund rose by 90% between 2016 and 2018. That's another period when the economy was subject to many rate hikes. For Tesla stock investors, this should be reassuring. Ford may have been hailed as the auto industry's top growth stock for 2022, but Tesla certainly has the power to surpass it. This stock could be in for some exciting growth in the next 2 years. Tesla recently signed a large deal with Rio Tinto in Australia, and now this further adds to its supplies. Tesla has battery factories in Texas and Nevada, so securing domestic supply will enhance efficiencies and reduce logistical costs. The deal is for 75,000 tons of nickel, which could be worth up to $1.5 billion. The China Passenger Car Association released data that showed Tesla delivered 70,847 vehicles from its Shanghai plant, a record since it opened. Tesla delivered 936,000 vehicles in 2021, with 473,000 coming from China. Forecasts for 2022 deliveries are for 1.4 million to 1.5 million vehicle deliveries. From the look of things, China is the key to Tesla's success in 2022. Now, Tesla is likely to double its production capacity by the end of 2022, and there's plenty of reason to believe that assessment. Tesla is currently wrapping up the launch of 2 new superfactories, one in Austin, Texas, and one in Berlin. At the same time, it's expanding its Fremont, California location, and it's increasing production capacity at Gigafactory Shanghai, while scouting new locations in other countries. With production success comes greater revenue, higher profits, and stock growth. The year is just getting started, but as we get ready for coming increases, Tesla is certainly worth watching. Thanks for tuning in today. Don't forget to like, share, and subscribe, and we'll see you next time right here on Stacking Stocks.